and I will be moderating today's webinar. I will begin by introducing the Capital Pathways program, introduce myself, and then pass the mic to our guest speaker, Ben Westerman, a business credit coach and senior account executive with our partner, NAV Technologies, NAV. He will introduce himself and take us through a presentation on credit building for small businesses. As we go along, please feel free to ask questions using the Q&A function, and we will respond to those at the end of the presentation. For questions that we can't respond to today, please send us an email and we'll happily address them through our no-cost one-on-one advising services, or we'll connect you to resources that can help you. We will share a recording of this webinar as part of our follow-up to today's webinar. In an email to today's webinar. So what is the Capital Pathways program? It's a program funded by the U.S. Treasury SSBCI initiative. It's sponsored by the Virginia Department of Small Business and Supplier Diversity, and it's hosted by the Virginia SBDC and George Mason University. We can start with the program overview, then we'll go through the program eligibility and finish up with an outline of the services we offer. Capital Pathways is a no-cost specialized SBDC program that helps Virginia-based small businesses and nonprofits build the systems and habits needed to become capital ready. Being capital ready matters because businesses that are less prepared can self-select out or fail loan applications. Early failures correlate to lack of adequate capital. Higher cost alternatives don't build long-term capacity. Ultimately, only half of the loan amounts requested reach small businesses. To put things into perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, only 20 to 30% of those who apply actually get their loans approved. To help address this challenge, Capital Pathway creates a path to financial and legal readiness. Our program offers an immersive hands-on group experience paired with one-on-one support. Who is eligible? Very small businesses and nonprofits at any stage who are based in Virginia and face challenges accessing traditional financing. The services we provide include a guided self-assessment, legal structure validation, financial skills and tools, loan application readiness, and credit building advising. We start with a self-assessment that pinpoints your business's key gaps so we can connect you with tailored resources, either through the Capital Pathways program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through basic legal questions, and we partner with a law firm, which can help with more complex topics related to business registration, trademarks, and contracts and agreement reviews. We also offer financial webinars on topics including financial basics, financial statement preparation, and QuickBooks training. Our one-on-one tailored support covers business foundations, profitability and pricing, financial forecasting, financial options and readiness, financial statements and tools, loan readiness, and lender prep. Those loan application readiness services include both webinars and one-on-one individualized support. These webinars cover topics such as what lenders look for in loan applications, interactive mock loan interviews, SBA loan options, and sample application analysis. We also have a partnership with a lender that provides one-on-one support to those looking for capital. After today's webinar, the next stage of our Credit to Capital credit building program is to schedule an intake call for one-on-one advising. During those one-on-one sessions, your advisor will work with you to review and interpret your business and personal credit reports and build an individualized credit improvement plan to strengthen your credit and help you qualify for better financing options and terms. You can register for the intake call using the QR code on the screen or reach out to us directly at capitalpathways@virginiasbdc.org. And I will share this email in the chat momentarily for you all to have. Now on to introductions. As mentioned before, my name is Sheila Lamb. I am today's moderator and serve as the customer support specialist for the Virginia Small Business Development Center, which offers the Capital Pathways program. Today's session will consist of a 90-minute presentation. Again, feel free to ask any questions throughout the presentation via the Q&A function. We will be responding to those at the end of the session, time permitting. Any questions that we can't respond to in this webinar, we are happy to address through our no-cost one-on-one services or connect you to resources that can help. We will share a recording of this webinar in a follow-up email. Now I will pass things over to Ben to introduce himself, tell us a bit about his background, and start the presentation. Thank you for joining us.
All right. Thanks, everybody. I appreciate it. I appreciate the introduction. My name again is Ben Westerman. I'm from nav.com, NAV. We help business owners build business credit, looking at other business services, and making sure they're in the best possible position, depending on what your goals are. I've been at NAV 12 years now, so I'm passionate about helping business owners finding solutions, and helping them reach and attain their goals. So again, really excited to be here. I know we have a number of participants here, so again, appreciate everybody spending their time this afternoon or morning, depending on where you're located. So as we covered here, we're going to go over some slides and really highlighting specific areas of focus. As you can see here, phase one, some of the modules, that we'll be covering, credit laws, your consumer rights, and just again basics around that, as well as your personal credit scores, reporting. What does it mean, right? What does it mean for you as a consumer, as well as you can kind of see there on that number 3, business credit scores and reporting, right? So we'll be covering those areas and more in this. So let's just jump right in. So again, the first one here, we'll be covering credit laws, consumer rights, and really the history of the American, credit score and the impact for you. So there's really 4 key areas or key laws and rights here. The first, bottom left, is the FCRA, so the Fair Credit Reporting Act. And again, we'll cover each of these in detail on what each of these are and how it impacts you. The FDCPA, so that's the Fair Debt Collection Practices Act. FACTA, which is the Fair and Accurate Credit Transactions Act, and then the ECOA, which is the Equal Credit Opportunity Act. Again, we'll dive into each of these individually, and again, if you have questions, feel free to put them in the chat, and as we outlined, we'll answer those at the end, time permitting. So the FCRA, right? So this is ensuring accuracy, fairness, and privacy of consumer credit information. So your credit information. So key areas or key scope, right, and areas of focus is regulates the credit bureaus. So Experian, Equifax, and TransUnion. Consumer the right to access and dispute, right, any inaccurate or wrong information on those reports, and then a big part here is have that information rectified or fixed, right, if it is inaccurate or out of date. And so with the Fair Credit Reporting Act, again, that gives you access to your free annual credit report, which again, you can go to annualcreditreport.com. 30-day investigation requirement after dispute. So it can't just go on forever, right? If you do dispute something, there is a time constraint and a requirement on that end. And then also must be notified, right? If you're denied for credit, right? So and why that is, right? What's an area that you need to focus on or potentially fix, right? So that's called adverse action notice. So that's the FCRA, again, the Fair Credit Reporting Act of 1970. And then again, this is the FDCPA, which is the Fair Debt Collection Practices Act. And so ultimately, this protects you as a consumer from abusive, deceptive, or unfair collection practices, which again below really highlights what your protections are and what this means. So, what it prohibits: harassment or threats, right, from a debt collector, calling before 8 a.m. or after 9 p.m. your time, calling repeatedly to annoy or facilitate some sort of action. False representation, so pretending to be a lawyer or a law firm or a government official, and then discussing debt with unauthorized third parties, right? That's your information. They're not allowed to share that with anybody, right? So again, those are some of the some of the protections and what it prohibits. What are your rights, right? Again, right to request debt validation within 30 days. Right to demand collectors stop contacting you. That has to be in writing, right? There are some ways, like through text or different things, where you can request them to stop. But to stop them entirely, again, that has to be in writing and sent to the collector themselves. But again, even if you have debts and they're trying to collect, right? Like you still have those rights as a consumer. So the FACTA, so this is the Fair and Accurate Credit Transactions Act of 2003. So this is really the main focus is to reduce identity theft and improve accuracy. So this is an amendment to the FCRA that came out in 1970. So again, it provides free annual credit reports and fraud alerts, right? So that's where this edition comes in. Identity theft protections, truncation of credit, debit or debit card numbers on receipts, disposal rules. So again, if a collector or a company that you're working with, they have to properly destroy sensitive information. And then what is the business impact for you and your companies, with the FACTA? Again, businesses must protect customer financial data. And then again, we highlighted this already, but the secure document disposal. So again, it's on both sides with consumer and business, making sure on that. The ECOA, so the Equal Credit Opportunity Act of 1974. So this is, ultimately ensuring fair access to credit for all, right? So what is the purpose? To prevent discrimination when it comes to lending, regardless of the product or anything of that nature. So lenders cannot discriminate based on race, color, religion, national origin, sex, marital status, age, public assistance income, exercise of consumer rights. And again, we've highlighted this, but key protections, that adverse action notice, right? Letting you know the reasons for if you are denied, why were you denied, and having it be very specific. And then again, scope of credit. This applies to both personal and business credit. And so again, those are the four main laws and consumer protections that we wanted to highlight here in this deck and in this presentation. So personal credit scores, reporting, and monitoring, right? What does that mean for you? And what is a credit report? What does reporting and how can you monitor it? So credit score versus report, right? So the credit score you can see on the left side there, in essence, it's a numerical snapshot, right, of where you're at in that moment once the credit was pulled. It's calculated from your report, and again reflects your current risk level. And so that's the score. The credit report shows full historical record. It really gives you the whole story, right, rather than just a score, because there are situations where you may only have one account on your credit report, but you could have a 780, right, or an 800, right? So the report really gives the details on where your score's at and why, right? The reason why. So this includes accounts, payment history, balances, and of course any public records. And again, lastly, there we hit on this, but really it's your long-term history. And so again, it's just important to understand there is a difference, right? There's the score itself, but then there's the report that gives all of the information. So personal credit score. So again, this is based on your credit report, based on the information from that. Going from top left in oh geez, it just went out of my head. In clockwise, right? So going clockwise determines credit risk, right? Helps lenders determine your overall credit risk, and the risk of default. Bottom right there, score models and providers. So there's really FICO, and then there's Vantage, right? Those are the main, really the main two when it comes to personal credit. And so understanding those, which we'll dive into more, and what the difference is, again, we'll highlight. And then as we kind of went over already, but it's used for loan decisions or lending decisions overall. But there are other factors as well that they do look at. But again, that's your personal credit score. So like I said, looking at FICO and Vantage, right? There's a couple of differences, and really it's around how they're calculating the information. So the information is the same on both, but it's just how are they calculating that. So typical score range is 300 to 850. With FICO on the left, you'll see, payment history is 35% of your score. Outstanding debt is 30% of your score. How long have you had credit? So your credit age. New applications, so inquiries, things of that nature. And then the different types of credit, whether they're revolving accounts like credit cards or a home mortgage, which is more of a term loan, or an auto loan, which is more of a term type option. With Vantage, again, with this presentation, you'll see it's similar, but again, a little bit different. So past payment history is still kind of the high area that they're looking at, but the age, so your credit age is highly influential. Percentage of credit used, so your utilization, again, highly influential. Total balances of debt, recent credit behaviors or inquiries are less influential, and then available credit is less influential. Main thing with this slide specifically is, again, just understanding that the information with both FICO and Vantage will be the same, but it'll be calculated a little bit different, a little bit differently, depending on which one you're viewing. So, what are personal credit reports? So, we just went over the credit scores, right? And a little bit around the reasoning the score is there, what lenders are looking at when it comes to the score, and then also the FICO or Vantage scoring models. So your personal credit reports. So your reports, a record of how you have managed credit accounts in the past. So it tells lenders the following information. Number one, who you are, right? Number two, how much debt you have and how long you've had it. Number three, how frequently have you applied for credit or a loan? How much credit is available to you, and how much you're using. And I know we touched on this before, but again, that has a big impact when you're talking utilization, of your credit and your payment history. Whether you've made timely payments for credit accounts, and then lastly, whether there's negative information about you in public records, bankruptcies, such as bankruptcies, foreclosures, judgments, things of that nature. And I know we touched on this before, but the three major personal credit or consumer credit bureaus, we have Experian, Equifax, and TransUnion. And how they, just want to highlight on this slide here, how they collect their information and essentially get it onto your report. So you have the creditors or public records, which again, that can be that can be anything from judgments, bankruptcies, foreclosures, anything that is, again, a public record. That information from the creditors and public records goes to the credit bureaus directly. They then put that onto your credit report. And then, depending on which site you're utilizing, right, to monitor or pull your credit reports, that's where, again, you're able to see that information and access that. And again, differences between their scoring models. Again, each bureau does it a little bit differently, right? They're their own entities. So it's not, they are governed, right? But they are their own entity. And so you can see down there at the bottom, again, scoring models and algorithms may vary, leading to different scores. I know I've experienced it, right? Where it's the same information with, or very close to the same information with all three of them. But the score is maybe 30%, or excuse me, 30 points one way or the other, just depending on again, multiple, whether it's the bureau or it's Vantage or FICO. So again, just keep that in mind. Want to make that clear that just understand when you are pulling it, know the bureau that you're pulling it from and the the type of report that it is, whether that's Vantage or FICO. So personal credit information. So reports from consumer credit reporting agencies generally contain the same basic information categories. So we have number one, the personal identifying information. Number two is credit history. Number three is inquiries. And then number four there is public records. And as you can see with each of those, it goes over, what information falls in each of those areas. And if you have questions on that, feel free to put them in the chat, and we'll be able to answer them at the end. So, so how to access free personal credit reports, right? So you're entitled to a free credit report through annualcreditreport.com. You want to check regularly and within 60 to 90 days censure before applying for credit. Helps ensure accuracy and address errors. If you know that you're going to be applying for any type of credit, knowing in advance if there's anything on the reports that's either inaccurate or that needs to be updated or worked on, right? Knowing in advance, a couple of months can be the difference between being approved or denied, right? So just understanding where you're at is very important. And then again, request your free reports at the same time from all three credit reporting agencies, just so that way you have all of the information at that same moment in time. As we all know, your your payments can come out at different times, right? So just staying on top of those and then pulling them at the same time can really help to build transparency for you as the consumer on where you're at. And because if you're pulling them at different times, again, it's not always going to be, the same across the board because of payments and when they're reporting. So credit monitoring options. Again, you have the free monitoring apps. So you have Credit Karma, Experian, Credit Sesame. We also do that here at NAV. Or you can use your financial institution app, right? So if you have a credit card or through your bank, typically they offer a free service to go along with that. But just making sure that you are on top of where you're at with your credit is extremely important, especially when you're getting prepared for funding. When personal credit history is important for your business. So this is kind of shifting over to the business side. So key situations on the left. So establishing a new business, right? It's very important because again, they don't have anything to go off of on the business, right? So they're going to be, going off of and utilizing your personal credit history. Personal guaranteeing or co-signing for a business loan. Accessing financing to grow an existing business, depending on, again, the product and the terms and personal credit is still a factor and something that they're going to look at and want to understand where that's at. Obtaining trade credit from suppliers, depending on what your business is and what you do. Oftentimes that can be just as important or beneficial for your business as getting a line of credit, right? Again, depending on what you do. But again, your personal credit is going to be a factor in that. And then qualifying for other business opportunities. So whether you're, you know, business to business transactions or business to government, right? Um, Business credit, which we'll cover here in a minute, is public knowledge, right? So another business or government entity, if they're going to be maybe signing a partnership or lending money or having some sort of relationship, again, that is important on the personal side as well as the business. So on the right, the personal guarantee and new business. These are quite common, and so we really wanted to highlight this. So if your business is new and you have not yet had the opportunity to build your reputation or establish your business credit history, therefore your ability to secure loans and contracts will depend heavily on your personal credit history. Again, they don't have anything else to go off of, right? In most circumstances, a lender may require you to personally guarantee a loan as a guarantor. You are personally liable for the debt, even if the business is unable to make payments. So consider the risk and the terms carefully, and if it makes sense for your business. Again, we really wanted to highlight those two situations specifically to give some context around why personal credit history is important for your business. Especially again, it's not just these two but again, these are situations that we run into, and so really wanted to highlight those today in this presentation. So module 3, so business credit scores and reporting, right? So really want to dive into that, and what is a business credit score? What can you do to improve it? What are the impacts of that? So differences between personal and business credit reports. Personal credit scores generally measure similar factors using information from personal credit reports and have similar ranges. Business credit scores use a wider variety of rating systems focused on measuring different factors from the company's business credit report and outside sources. And again, we'll dive into this further, but depending on the business bureau, there are different scores that you can get from that, such as a business, a delinquency score, a business credit score. Again, we'll go into that in more detail, but there definitely is a difference there, and so again, wanted to highlight that with this slide. So business credit scores. So on the left there, we have the Dun and Bradstreet. They use what's called the Paydex scoring model. That goes from 1 to 100. And this reflects business payment history reported typically by vendors. So that supplier, right, that you may have, or a gas card maybe you use. When I say a vendor, that's what I'm referencing. And then used by suppliers for trade terms, such as net 30 terms, net 60, net 90. And again, you'll see there that Paydex 80, right? I'm not sure how many of you have heard that being said, right? I want to get an 80 Paydex score. That's very common. And Dun and Bradstreet is, one of the largest business bureaus out there. And again, we'll dive into that more. But Again, that is range from zero, or excuse me, 1 to 100, and they use the Paydex scoring model. So then in the middle there, we have the Equifax Payment Index. So that goes from 1 to 100 as well. So again, similar to Paydex, it predicts the likelihood of severe delinquency or failure within 12 months. And again, with Equifax, whether it's a loan or a vendor or supplier, there each of these business bureaus are starting to get more and more information and more data. And so business credit is becoming more and more relevant when it comes to, you know, understanding your financing options. And then on the right there, or excuse me, on the right side there with the Experian IntelliScore, that's what Experian uses. Again, they're from 1 to 100, and again, calculated from numerous data points, right? From payment history, trade lines, public records, and more, such as business information. So your address, making sure all of that's accurate as well. So again, these are the three main business bureaus out there. And that's really, as you saw with the 80, 75, 85, you know, that's really where you want to be, and we'll cover that in more detail as well. But those are the business credit scores overall. So your business credit report. So what are business credit reports? So again, similar to the personal side, they provide information that could help lenders or other businesses assess risk and tell others about your past credit performance. Differences from personal credit. I know we highlighted this a little bit already. Personal credit is private, right? And business credit is public. So again, that's a huge factor and a huge difference when you're thinking personal and business credit reports. So general information on your business credit report is business credit, as I said, identifying information with address, your SIC code, number of employees, key personnel, right? Those are the type of, when I'm saying identifying information. Business credit history, business background, registration and financial information, and then public record information. So that's kind of the general areas there. So diving into this phase two of the modules, we'll be going over why credit matters when you're seeking capital. How can you build and maintain good personal and business credit scores? What lenders are looking for on a loan application, and then analyzing personal and business credit reports. And again, this will be, I'm going to go over it. And again, if you have questions at the end, we can definitely go over those specifically. But that is, again, what we'll be covering here with the phase two. So why credit matters when seeking capital. Whether you're looking for a loan, home, cars, business funding, right? Higher credit scores obviously is lower risk for lenders. Typically, you're getting better rates and terms. And when I say that, obviously lower interest and longer terms, so longer time to pay back. Another key factor, debt to income ratio. you've probably heard that DTI, that reflects income available for loan payments. So what you're able to, or what you have available to make those, is a key factor when determining any type of these type of loans. So again, pretty self-explanatory, but lower or no credit scores, higher risk, may be denied, and then higher interest or shorter terms, right? Depending on the product. So how can you build and maintain a good personal and business credit score? We'll go over both of those. So what is a good personal credit score? Higher scores indicate lower risk, factor debt to income, and really the benchmarks is what I wanted to highlight here. So if you're looking, for lenders to be comfortable, you really want to be that at least that 650 or higher. Strong borrower 700 plus, and then top tier credit 740 plus. But again, keep in mind that what's on the report is what generates the score. And so just understanding what's on your report and how you can make sure you're in the best possible position. So with the business credit, the key benchmarks, Dun and Bradstreet, as I said, really 80 plus, right? An 80 Paydex is what you want to, where you want to be. Experian, really 76 to 100, puts you in that lower risk for a lender or business. Equifax, using the payment index, really 80 to 100 is on-time payments. And then I know we haven't touched on this too much, but the FICO SBSS score, really you want to be at that 161 to 190. That puts you in a good range. And then 211 to 300 puts you in the excellent range. And the FICO SBSS is specific for SBA lending. And so it takes into account personal and business credit and information and generates what's called the FICO SBSS score. Again, I know we haven't highlighted that, but I just wanted to cover that in some detail here. So give me just one second. I apologize. Okay, so how can you build and maintain a good personal credit score? Number one, right? Pay your bills on time, right? That's a big one. Late payments or accounts going into collection, it will very much impact your credit in a negative way. Keep utilization down. Really, you want to be at that 30% or below. And when I say utilization, we're talking typically credit cards. So you see credit utilization. That's another key factor that you want to again stay on top of and continue to maintain and get you in a better position. There's also secured credit cards out there, right? Those can be some good options to really maintain and build your personal credit. Become an authorized user. So that's if you know someone that maybe has a credit card that they're willing to add you on as an authorized user, that can be another way to improve your personal credit. And then lastly, monitor your credit, right? Know where you're at and know where you need to focus on either paying down debt or, again, just making sure that you're in the best possible position moving forward. So those are some areas from this presentation on your personal credit that you can do to, again, continue to put yourself in the best possible position. So build and maintain a good business credit score. So let's go ahead and jump into that. So why should you establish, business credit? Lenders, right? So they check business credit reports and scores to determine terms and rates and eligibility. We and again, I know we highlighted this a little bit, but this will get into more detail. Suppliers and shipping, review credit history for deferred payment options, such as net 30, net 60, net 90. Customers, verify company is a legal and reputable entity. Insurance companies, and then lastly, procurement officers evaluate ability to execute government contracts. So those are, again, 5 reasons why you should establish business credit and maintain it. Is customers, partners, lenders, insurance companies, and again, if you're doing business to government, right, procurement officers. So how can you build your business credit score? So these are some steps again that we can take, and in the individual coaching we definitely go into this in more detail. But you want to make sure that you have your identifiers, right? So your employer identification number, your DUNS number, which is your Dun and Bradstreet number, making sure that you have those established. And that's a unique identifier, for your business. Check existing history, right? So search for your company on credit reporting agency websites. And again, request reports and verify accuracy. Make sure it's all the correct information on your business. Number 3, this is a big one, right? Establishing reporting relationships. Not all vendors or suppliers or lenders are required to report to Dun and Bradstreet, Experian, or Equifax. So that's a big differentiator from the personal side. With the business, they're not required to report. And so, as you can see below, ask lenders, suppliers, and vendors to report to the bureaus. Build relationships with those who do. You can request that a vendor that you've been working with report to the bureaus, as it says here. But identifying those vendors and lenders and suppliers beforehand and establishing those relationships are key. So that number 3 is very, very important when you're talking how to build business credit. And then number 4, build and update history. So regularly update information and correct inaccuracies. Just like on the personal, you want to make sure you're monitoring, you're identifying changes, and updating, again, any inaccuracies or wrong information. So best practices for strong business credit. And I know we've highlighted a little bit of this before, but again, payment discipline, understanding, what you're able to manage and handle when it comes to payments, whether it's with a vendor or supplier or a lender. Understanding those impacts are vitally important. because payment discipline is huge. Paying on time. Number two, business visibility and relationships. So I know we highlighted this before, but those relationships, maintaining them and making sure that you're establishing them with vendors that report or lenders that report, allow other vendors, other lenders to see that, because it is public knowledge under the business, with the business bureaus. Number three, financial separation and advice. So, separate personal and business finances, seek professional help, professional advice, excuse me, when it comes to, you have your personal, checking account, you have your business checking account. So again, separating as much as you can is very important. Number four, credit acquisition and monitoring. I know we've highlighted this, but obtaining credit in your business name, and then again monitoring and staying on top of your credit. So, what lenders look for in your loan application? Let's dive into that. Sorry about that. So, diving into that, so the right lender for your business. So there's really three core areas. Obviously, there's credit cards and things of that nature. But looking at lending specifically, you have your big banks, right, that offer the best loan terms, and they focus on large financing needs and loan amounts. And then you have medium banks and credit unions, often accessible to small businesses with good credit, and financial history. And then lastly, you have the small banks or CDFIs, and/or CDFIs. So they're more accessible to small, underserved entrepreneurs, startups, those have lower credit, often more of the smaller micro loan type options, and usually again are shorter in length of term, so on and so forth. So those are kind of the three core lending options that are available for your business. So the 5 C's of credit. Number one, character, refers to the borrower's reputation and track records of repaying debts. Capacity assesses the borrower's ability to repay the loan based on income and existing debt. Capital, looking at assets, and net worth and financial stability. Collateral is number four. You know, that's obviously, assets that can secure or help secure a loan product or products. And then conditions is number five. So looking at the overall economic environment. And so those are, takeaway from this presentation. Those are kind of the 5 C's of credit when you're looking to apply, making sure that you have those checked off, and understand each of those areas. So debt to income. I know we highlighted this a little bit before with the DTI ratio. But ultimately what that is it's your total monthly debt divided by your gross, so not your net, but your gross monthly income times 100%. That gives you your debt to income ratio, especially for startups and small businesses. Lenders are going to be really looking at that, to see if loan payments can be supported. with your current debt and your current income. And so, again, just wanted to highlight that. I know we touched on that a little bit earlier, and we're going to share these slides with everybody, so you can view them and have it for your record. Before you contact lenders, right? What should you do? What are steps you should take? Number one, check and improve your credit, right? Make sure that everything's accurate, or if we need to change it, take those steps. Research your options, right? There are different types of loan products, and lending institutions, as we highlighted before. Look into if you want a loan or a business line of credit. Look at online loan calculators to understand total cost and repayment. Know your numbers, right? So once you have identified lenders, right, request what documents you should collect. Here, I, again, want to highlight what are most common, what lenders most commonly will ask for. For startups and established business, there on the left. What they're going to be asking for is a presentation to the lender with loan request. So business information, business plan, financial pro forma or projections, personal financial information, and then information on your management team, right? If you have one, and what that consists of and what their roles are and responsibilities. So, what is typically asked for additional for established businesses? What additional information? Financial statements, so profit and loss, or P&L, bank statements, balance sheets, tax information, are going to be factors. Again, depending on how long you've been in business and the type of product and bank or lender that you're going to. But before you apply, and once you've identified a lender, making sure that you have these available and put together and set up is very important. So be ready to answer these questions, right? There are more, right, that they could ask, but these are key for any lender when you're applying for funding. So number one, what will you use the money for? And they'll want in-depth information on the use of the proceeds, right? So understanding that, how will this loan benefit your business, right? What is the return on investment? And that's where that financial projection or pro forma really comes into play, is understanding where you're at today and have been previously. But by securing this capital, you're going to be able to do, A, B, and C, which will then turn into, an increase in revenue by X, right? Again, just an example, but those are two questions that they're definitely going to be asked, that they will definitely be asking of you in regards to this funding option and product that you're applying for. And then thirdly, are you willing to back the loan with collateral and or a personal guarantee? So again, those are three questions that they will most certainly ask. And so having the answers to those questions, as well as the information that we highlighted before with the business plan, financial projections, making sure that you're ready, to answer those and have that information. So documentation for startups and established businesses. So uh, again, this just dives in a little bit more when we're talking, identifying information and those areas that we just highlighted before. So what is a presentation to a lender outline, or what does it look like? So typically a storyboard telling your story, right, of your business. When did you start it? Why did you start it? What were you trying to solve? Those are a few questions that you definitely want to be thinking about as you're telling your story. So again, about you, your customer, your offer, typical sale, you know, what is your sales timeline? And again, that return on investment is something that they're definitely going to want to understand in detail. Is there competition, right? If so, who? And what information do you have about that? What's your marketing plan? How are you going to get customers? How are you going to get your product out there? Or if you've already been established for a while and are seeking capital, how are you going to market this product? Is it going to be similar to how you've been doing because it's been profitable? Or is there another avenue, right, that you want to, that's what this money is used for, is to maybe market a different way, right? So your marketing plan is important because it tells them how are you getting your customers? Summary financial plan and history. I know I touched on that. Previous and then future state. And then your ask, right? That includes how much you're looking for and those details that we highlighted previously. So again, that with the presentation to the lender outline, having that available and having that ready to show is very important as well. So business information. So documentation confirming the business structure and operations. So articles of incorporation or organization, depending. Making sure that you are, you have your business tax ID, depending on the type of business you are, right? Each state with your Secretary of State, you can establish your business. There are different fees and taxes associated, depending. But getting those articles, operating agreement and bylaws, business licenses and permits to operate in specific areas and business types. EIN, so your employer identification confirmation letter, which typically comes with your articles of incorporation. DBA registration, so if your DBA stands for doing business as, and again, if it's not applicable, that's okay. And then business lease or property ownership documents. So when we're talking business information, having really these 6 areas is something that you'll want to have available and ready to speak to. So a business plan, right? So a business plan takes into account, if you see on the right side there, you can see it shows history and management. product and services offered, loan proceeds and repayment, and then future plans. So again, going from the left clockwise, that's what your business plan entails. And it should be able to give them an overview and picture of what your history and what you do currently, what you offer, any loan proceeds that you currently have, and repayment, as well as this, and then what are your future plans. So that's what your business plan should entail. A sample of your business plan outline. So this is for a traditional SBA business plan. This is your executive summary, company description, market research and market analysis. Again, who are your target customers? What are your competitive advantages compared to other competitors or businesses that are in a same or similar industry? Regulations, right? Are there any laws or licenses or compliances that are required? What are your products and services? Pricing structure, product service life cycle. In essence, your selling life cycle, right? How long? What does that look like? Intellectual property, trademarks, patents, research and development, marketing strategy, customer communications. How are we going to interact with those that have already purchased? And then lastly, what is your sales strategy? So how the business will sell its product and services. So those are the areas when you're talking a traditional SBA, business plan, what you're going to want to be highlighting in that, and have readily available to give, when you are applying for a specific, product with a specific lender. So this one again, this is just another outline. SBA lean business plan, right? So this is, a smaller type loan. So identity problem, our solution, target market, competition, revenue streams, marketing activities, expenses, team and key roles, and then milestones, right? So it's just a little bit different on how it's put together, but a lot of similar information across the board. Again, this is just wanted to give you a couple of outlines on what that would look like. So financial projections, what are those, right? And what does that mean for you and your business? So typically lenders require 2 to 3 years revenue and expense projections. So again, understanding what is this loan or this funding, what is the impact of that in your projections? First year must be 12 monthly projections, and then detailed assumptions. Detailed assumptions explaining figures are mandatory. So if there's something that's very specific, right, or a jump in projections, explaining why that jump is happening, whether it's seasonality, whether it's a product deployment, whatever the case may be, right? So when you see assumptions explaining figures, that's typically what that's referencing. So personal financial information. So income and assets, right? What's your annual income? What assets, cash, investments, real estate, potential collateral? What are your net worth? What is your net worth? Excuse me. So your assets minus your liabilities. Um, and then on the right there, debt and obligations. So liabilities, debt such as credit cards, loans, mortgages, monthly debt obligations, and then again, credit credit history and your credit score. Um, and I know we already highlighted this, but verification documents. So that's kind of your personal financial information and what's going to be asked of you when you're applying is to be able to show that. So information on your management team. So names and titles, ownership, if they own a percentage, of the business, um, relevant experience, resumes, short bios, roles and responsibilities, and then time to commitment to the business. Are they full or part time? Again, when we're talking information on your management team, which is a factor and an area that they're looking at, that's what that means specifically on that front. So documentation for established businesses. So with that, typically we're looking at financial statements. So cash flow statement, you see highlighted there, most important. So this takes into account what's coming in, what's going, coming in as payments you're receiving, what payments are going out. Are very important and crucial to understanding, liquidity, right? Other financial statements, income statement, profitabilities, profit and loss, and then your balance sheet provides a snapshot of your financial position, assets equal liabilities plus equity. So financial statements, if you're an established business, is very important for you to add, and that's what when we say financial statements, that's what we mean. So cash flow understanding. I know there's gross, what you gross, what you net, all of that. What does that mean, and what does cash flow mean? So on the picture there, if you see up at the top, you have sales right in the middle, and then below that you have your net cash flow. You have your bills that go out, and then your cash outflow goes to expenses, cash flow in, right, to the sales. So ultimately, a good way to think of it is, again, you have your products and offering, you receive your net cash flow in, or your payment for those products or services. And that, when it says net, right, gross is what you bring in, before anything. Your net is after, and then you have your bills, and then that is whatever's remaining, right, is your cash flow, right? And so that's just an easier way to think about it for your business, whether it is a product or service or both. Just thinking of it that way will help. So bank statement requirements, most you're looking at it at least 3 to 6 months bank statements. So again, if you're an established business, just know that is an area that they're going to be looking at. And depending on the product, some will require both personal as well as business. Others just require business. Again, it just depends on the product itself. But one thing to keep in mind with your business credit, and I won't go in, or excuse me, your business bank statements. I won't go into into a huge amount of detail, but making sure that you're limiting your NSFs or negative days So ending the day with a negative balance or overdrafts, that's very important, as well as making sure you're not ending the month in a negative, right, with a negative balance. Those are just some areas that they definitely look at when they're when they're looking at your bank accounts, the last 3 to 6 months of your bank statements. Tax returns. So again, depending on the product, when you're looking at a bank, SBA, longer term loan options, you know, they're going to be looking at the last 2 to 3 years, and again, you'll see there at the bottom must typically be included in a small business loan application. So if you're looking for an SBA, or you're looking for a term loan product, that is typically something that's going to be required upon submission, if you're an established business. So this is a more of a hands-on exercise. Saying that, how I've done it in the past is I'm going to be pulling these up and I'll go over them. And then again, if you have questions or feedback at the end, we can definitely go over them. But what I would say is let's just go over these together. I'll manage it and talk through it. And then again, if you have questions, we'll cover them there at the end. So, how to read a credit report. So if we're matching these up, we're going to be looking at identifying personal information, understanding negative items, trade lines, hard versus soft inquiries, collections, and public records. So this is an example, right, of a credit report. So looking at it, this kind of breaks down the areas that we highlighted on the previous slide. So the personal consumer information, for those, most of you have probably potentially seen a personal credit report, but that personal information is there up at the top. The credit account summary, right? Accounts in good standing, public record information is down there at the bottom, and then credit history inquiries is down there at the bottom right. So with this next exercise, I'm going to go through these, and again, if you have feedback, feel free to add it, and we'll cover it there at the end. But understanding your personal credit report. So using the sample personal credit report, answer the following questions. Is this person current on their accounts? So I'm going to give you just a minute or so to look over it, and then I'm going to answer these. Okay. So, and I know we're kind of running up on time to the 90 minutes here, but is this person current on their accounts? So currently, right? What's their current status? Um, so as you can see here on this second one, this ABC Bank Card USA status open, but it's 60 days past due. So that's the current status. So to answer that question, is this person current on their accounts? That it would be no. Um, do they have any open accounts that are in good standing? If yes, which ones? So this one here, this Somewheresville Community Mortgage Bank, status is open, current, but it has previous history of late payments. So technically, this is in good standing, but it is it did previously have late payments. But this one would technically be in good standing currently. Do they have any public records? So again, this bottom left portion, public records, no public records listed. So no public records. And then lastly, have they applied for credit recently? So that bottom right side, if we're looking at it, requests for credit, there's a Visa card, and the date was 4/1/16. So that recently, they're looking at the last 2 years. So I would say yes, right? They've applied for credit recently. So, oh, sorry. So that's kind of where we're at with this one and those answers. Again, if you have feedback, we'll cover it there at the end. Identifying and disputing errors on your personal credit report. So this is the same report as this one, right? So we have the Somewheresville, ABC bank card, televised cable communication, and then these accounts that are in good standing. Excuse me, yeah. So technically, there's this one here that's never been late, and then this lease equipment. So yeah, most definitely this one have any accounts that are in good standing. They actually have these two. So there's three: Somewheresville, ABC bank card, and televised cable that they want to dispute. And we want to make sure when we're disputing that we're not just frivolously disputing, right? Just marking everything and disputing it. Uh, Typically, you're able to file a dispute online, but you want to make sure that you have documentation that definitely helps when you're submitting a dispute. But as I said, making sure that you're disputing specific items is very important. So in this situation, right, disputing these, and here are the steps, right? What are the dispute process actions on the steps that you could take to dispute those items? And then we'll just go over this quickly. So check to make sure your information is correct. Business identifying information, we went over that before. Business credit history. And so we'll cover that on this example business credit report. Take note of the scores listed in the report. Again, we highlighted this again just to look at the different types of scoring models with Paydex out of 100, IntelliScore out of 100, and then that FICO SBSS is 0 to 300. Step 3, check to make sure your information is accurate. So business background, registration, and financial information, public record, financial information. And again, we should be, and then identifying and disputing errors on your business credit report. Oh, I did right. I apologize. I thought we had, so takeaway from this on the one-on-one meetings and coaching, we will go over your business credit, so your company's credit, with Experian, Dun and Bradstreet, and Equifax. And so we'll be able to, again, look at these key areas. If there's anything negative, again, there are steps that we can take to dispute or look to get that information, off of your credit report. Um, so, so yeah. So with that, I think we're at the end here. Let me see here. Yep, that is the end, and I think we're. I it went a little bit faster than I thought it would. I apologize. But do we have any questions?
Ben, we do have a couple questions that have dropped in. I think we can probably get through them quickly.
Okay.
The first one, what PAYDEX score range is generally considered good by lenders, and what score is typically required for a business to qualify for loans and other financing?
Yeah, so great question. So a good way to think about Dun and Bradstreet and the Paydex scoring model, um, as you saw earlier, uh, that 80 Paydex is really where you want to be, and that means on time payments. So the only way to actually get above an 80 Paydex to, let's say, an 85 or a 90 is you need to have vendors on there that report that you're paying early. Okay, so ideally you want to be at that 80 Paydex. Now, Dun and Bradstreet does require that you have at least three accounts that are reporting to Dun and Bradstreet to generate a score. So if you only have one or two, you may see that your score is either zero or NA through Dun and Bradstreet. So, but just keep that in mind. Sometimes well, not sometimes, you need to have that, at least have those three to have that. Now, to answer your question on what your score needs to be, I would say you really want to be at that 80 Paydex or as close as you can be to that. Because that's going to open up eligibility options with other vendors, lenders. Again, business credit is more relevant now than it's ever been when you're talking, applying for lending. So again, hopefully that helps, but you really want to be to that 80 Paydex or as close as you can be to that.
Okay, thank you. Next question. What happens if you are an authorized user and the account holder passes away? How does it affect your credit?
So that's a really good question. So typically, what'll happen is they will close. Once they're notified, they will close that account out. Um, that will then typically typically move to a closed account. Now, if there's a balance, right, that's something that you'd have to work with whoever the estate owner is and what that plan is there. But ultimately, they can take you off. Whoever is in charge of that card can take you off as an authorized user at any time. So if you do run into that, I would just talk, whoever is in charge of that estate, and get your name taken off as an authorized user if
Okay.
there is a balance. So.
We have one last question. When the account is closed at the consumer's request, does it affect your credit score?
So that's another great question. So, um, anytime you're closing or opening an account, it can definitely impact your score, right? I can't say exactly how much it will or won't, but again, like we covered, credit age, right, is a big part of your score. And so if you're closing accounts and it's an account that maybe you've had for years, right? Or maybe it's one that you just opened, right? That's going to have an impact. So just keep that in mind as you're thinking through opening and closing accounts. That can definitely have an impact on your score.
Would you say it's better to leave an account open in that case then, with just no
Yeah.
use?
Yeah, if it's at zero, if the balance is at zero, like for example, yeah, like a credit card, right? And you're like, hey, I just want to close it out. I'm not going to use it. In my experience, it's I would prefer to, again, this is me, right? I would prefer to have keep it open, use it very minimally. But that way there's still some record. I'm making a payment each month. Again, it doesn't have to be a huge amount, but that way you're still having that account build your credit,
Sure.
right? So
Sure. Great. That's all the questions, and we are right at 1:30, so I'd say
excellent.
excellent. Exactly. Ben, thank you so much for this excellent information and for your time. And I want to thank everyone who joined us today and remind you that a recording of today's session will be shared as part of a follow-up email that will be sent to all participants within a week of this webinar, along with the slides. Let's see if we couldn't get to your question, but I think we did. But if you have other questions that come up, please send us an appointment request through our
Yep.
website email, and we'll be sure to help or connect you to resources that can that can support your business needs. We thank you very much, and we hope to see you all at future webinars. Take care, everyone. Bye.
Thanks, everybody. Bye.